Hello, investors. Welcome to our monthly interaction. There are certain events on the horizon which are critical, both globally and locally. Let us look at them one by one. So, when you actually first come to the global aspects, how are things working on macroeconomic side? Clearly, it seems as if the inflation, the unemployment data, or the general consumer confidence in US remains fairly high, which is hindering the interest rate cuts which were expected. So clearly, the inflation data is suggesting that it is likely to take longer time than what people were anticipating. For all practical purposes, it looks like you are not going to get any interest rate cuts this year in US. Probably towards at max one cut, probably towards the end of the year post-election in US. Why it is important? It is important because it also means that even domestically, we are unlikely to see interest rate reversals or interest rate cuts, given that these policies are interconnected in a way. So that's one thing that is happening. So from a stage where about 6 months back everybody expected probably 3 to 4 interest rate cuts in US this year, you come to a stage where probably you will not see any interest rate cuts. What are the repercussions? Repercussions are very clear that you are likely to have a higher interest rate environment for a longer period, and which logically should have its own repercussions for the growth. And that's where you saw that the first week GDP growth rate has come from US, which was the last data point, which was fairly lower than what the people are anticipating. So that's the environment in which we are operating. The other aspect which is critical from global perspective is the global geopolitics and what is happening in the wars between Israel and Hamas, and on the other front between Ukraine and Russia. Clearly, Ukraine-Russia has gotten elongated, but its impact on supply chain over a period of time on the energy and fertilizer side has receded significantly, as you can see. As far as geopolitics is concerned, our take on this is you are unlikely to get escalation as a base case in the Middle East, and thus the elevated energy prices that you have seen will remain there for some time, but unlikely to escalate between a war between Iran and Israel, at least till the US elections, and thus the energy prices are unlikely to kind of go through the roof, which would have been a terrible thing for India. So that's on the geopolitics. That impact of geopolitics on the energy prices are likely to be more intermittent rather than actually a substantial and disproportionate impact, which can impact the growth in India. To summarize the global aspects, the growth continues to remain resilient but incrementally slowing, which means your export-oriented sectors, certain sectors like IT and certain other commodities or engineering exports will continue to have a little difficult time in terms of the growth rates, which is already visible in these quarterly results as far as IT is concerned, because most of the IT results are out. Second, the capital flows probably in this kind of environment, either the valuations have to really be attractive or the earnings growth has to really get upgraded for strong capital inflows. And that's where emerging markets, in an environment where in US you are getting 6, 7, 8% in the basically AAA rated or AA plus bonds, it's very difficult to expect a sustained and very, very strong capital flows. And those are the two critical takeaways for us in our view, that or three key takeaways. The growth rates remain muted or likely to probably further slow down as an outcome of higher interest rates. Second, thus capital flows will wait for either the earnings uptick or the valuation correction or combination of these two things. And third, you have geopolitical challenges on two fronts, but its impact on energy prices in our view is likely to be more transient, at least at this point in time. So those are the three key takeaways for the global environment. Coming to domestic environment, as far as macro is concerned, in fact, as it is just a continuation, as we have been seeing, the tax collection remains good. The current account deficit is barely 1% for financial year 24, so there is no external funding challenges. You have inflation. The last data point was below 5, so again the inflation remains under control. The WPI inflation is actually running very, very low, which means the domestic inflationary pressures are limited. Most of the other data points on real estate side, auto, remain good. Fiscal deficit, as has been said, probably will start coming under control post-election, as has been guided by the government. So most of the macroeconomic parameter remain healthy as they were. It is just a continuation, and that continuation in terms of manifestation of the factors remain that the domestic balance sheets are fairly healthy, which means they are in expansionary modes. Whether you take the private capex through private balance sheets or corporate balance sheets, whether you take the household capex through the real estate, whether you take the government capex, which has consistently been productive on the capex side, and or whether it is the bank balance sheet, which again have been in expansionary mode, and the NPAs remain probably the pristine or the best that we have seen in 10-15 years. So most of the domestic balance sheets are at a stage where they are likely to keep expanding. So that's the domestic macro, which consistently indicates that you are in a business cycle, you are in a credit growth cycle, you are in an earnings growth cycle from a structural perspective, from a 2-3 years perspective. So that's the domestic macro continuation of the factors that were there. Nothing significantly, there is no significant deviation either on positive or negative side. Lastly, coming to the earnings and contextual earnings, I think that's where there is a little bit of a challenge. So when and we have alluded to this in the past also, if you actually just look at what is the expectation of earnings for this quarter, the earnings expectation for say BSE 500 or BSE 100 for this quarter is in single digit, and that's the part which is contextual worry in the environment where there has been a lot of front ending of returns that have happened in financial year 24. So financial year 24 clearly, while still at an aggregate level, it will be about 23%, 24% earnings growth for Nifty, and about 28 to 30% earnings growth for the broader indices in mid cap and small cap. Predominant part of it has been as a consequence of the margin expansion that you experienced in financial year 24. Financial year 25, probably that part will be very, very muted. And given that, the earnings growth is likely to moderate. Now, earnings growth will of course moderate in certain parts it will still remain healthy, but aggregate as a whole, we are expecting about 12 to 13%, 14% earnings growth in financial year 25 against 24-25% earnings growth for financial year 24. Even within that, the divergence that was visible in terms of the earnings pocket in financial year 24 between mid cap, small cap and large cap, our sense is the divergence of the earnings growth itself is likely to gradually recede this year, at least, given the way incrementally commodity prices are moving, given the way incremental margin possibilities are there, and thus moderation in the earnings is ahead for from a contextual perspective for the market. So that's the earnings view. Coming to the valuations still remain in a zone which is neither expensive nor cheap at the large cap zone. As you go down in mid cap and small cap, of course there are pockets where there is clearly a lot of exuberance. There are pockets which are good, but a lot of pockets where it is not about whether the businesses are good or not. It is just the expectations what are built in look fairly aggressive, and based on those expectations, there is a lot of upfronting of returns that has happened. So earnings growth for all three parts of the market is more likely to be in between 10-12% to 15% rather than 25 to 30% as you experienced last year. In that context, currently the Nifty is trading at something like 2021 time, neither very cheap nor very expensive. While it is little expensive in the context, if you look at the say 10-year or 15-year average or 20-year averages, we think that it is warranted, given that the top-down view in terms of, or the broader view in terms of a structural 3-year view hasn't changed. You are still in a balance sheet expansion zone, which means you might get a year where there is earnings moderation, but from a 2-3 year perspective, still we are in a zone where 15% earnings growth is more likely scenario than not. And given that scenario, it's very unlikely that the valuation multiples will correct significantly from where they are, and that's how we are looking at it. So contextually, little more cautious on market, little more guarded on market. From a structural perspective, anybody who has a 3-year view, still very, very constructive, given that the public capex which has started 2-3 years back by government, and which has been running at 25-30% CAGR, is likely to translate into private capex. It is likely to translate into job creation, and it is likely to translate into a nascent real estate cycle that you are seeing today. The real estate cycle is still concentrated at the higher end of the ticket size, but our sense is that the real estate cycle will also expand over next 2-3 years. And given this view, the earnings, if you take a 3-year view, still are likely to be 15%. In that context, it's very unlikely that the valuation multiples will correct significantly and they will go towards the low end of the averages rather than the higher end of the averages. So that's how we are looking at valuations. And lastly, there are events on horizon. So what are the risks to market? Clearly, from a risk perspective, the domestic event on election, although consensus is that the government continuation is the most likely scenario. With what majority government comes, I think that will also determine a lot of policies. So that remains the risk from a volatility perspective in market. Globally, while our base case is that geopolitics is unlikely to go out of hand, any event between Israel and Iran can actually lead to substantial increase in the energy prices, and that remains another risk. And coming lastly to our portfolios, within our portfolios, as you would have already guessed, we still remain quite constructive on the domestic cyclicals. At the same time, we started nibbling in some of the global cyclicals as well as the consumption part of the economy. While from a very, very broad perspective, domestic consumption and global cyclicals are underweight and domestic cyclicals are overweight. As I said, gradually we have started actually looking for opportunities on the consumption basket as well as the global cyclical basket. So just to put it in terms of sectors, industrials, real estate, cement, hotels, hospitals, consumer discretionary, auto, telecom, pharma. These are the sectors where the portfolios are overweight on. IT, staples, energy, commodities, these are the sectors where the portfolios are underweight on. Within the underweight, as I said, the consumption part of the basket as well as the global cyclical materials part of the basket is where we're incrementally exploring in terms of the opportunity set. So that's from our side for this month. We'll come back next month for a new interaction. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.